Well, watching the retail battle from the sidelines is Roger Montgomery from Montgomery Investment Management, who joins me now in the studio. Roger, welcome back.
Thank you, Ticky.
Well, I'm wondering, at $17 that Woolworths paid for David Jones, Ian Moyer says that history will prove them right, that this was a very good value.
Well, it potentially is. There's a couple of angles to this. You've got a business, you've got an asset that hasn't grown its revenue in a decade. So its revenue's been about $1.8 billion or thereabouts for the last 10 years. The expense line's been about $1.7 billion, and that's been constant for the last decade. So the business hasn't done anything. It's been in treading water mode all that time.
Profits have gone up a little.
Only marginally, from $60 million to about $90 million. But yes, they've gone up 50%, but it's taken 10 years to do that. The reality is, though, the company has about $600 million more in assets that it needed to generate that extra profit. So arguably the ROA, the return on assets, hasn't changed that much. But what Woolworths has demonstrated in the past is how they can turn a business around, and they did that with Country Road to such an extent now that Country Road represents about a quarter of their profits, the Woolworths South Africa profits. And so if they do the same thing in Woolworths, well, that combined with the way they finance the deal, and what I suspect they'll do is because they don't have the cash,
it's a big deal, isn't it?
It's a massive deal. Yeah. It is 4 times the size of the equity on their balance sheet. Right. So it's a $2 billion Aussie deal, and they've got about 500 million Aussie of equity on their balance sheet. So it's a very large deal. So they've bitten a lot off. They have to chew like crazy in order to do it. In order to finance the deal, even if they suspended their dividend, that's about 160 million Aussie dollars.
Which they can do because they're taking everything private.
Of course they can. Yeah. They can suspend the dividend. They've got cash in the bank of about $190 million. They've got about a $300 million facility, this is Aussie dollars, facility that they could draw down. That's not enough to acquire it. So they need a bridging facility, and then what I suspect they might do is some sort of a renounceable rights issue. That could be a way of then paying off that debt. And if your shares are expensive, then that becomes a cheaper way of financing the deal. Combine that with the efficiencies they think they can get, and it may prove to be a cheap deal. And
do you buy the synergy argument that Ian Moyer talks about? Combining Country Road and David Jones is something that the independent valuer didn't really take into account, and all his customer relationship management that he's going to be doing.
Well, anyone in our generation, Ticky, who had previously bought Country Road product in the 80s and in the early 90s would know that the product changed after Woolworths bought that product, and the business became more profitable.
You mean us old folk?
Yes, correct. You know, and the product changed materially, and as a result, the business became more efficient. Now, one expects that if they can bring their brands into DJs in Australia, they'll get the same efficiencies. There's also that property portfolio.
Yes, which Ian Moyer didn't really talk about.
He didn't really address that. Yes, you can keep the brand an iconic Australian brand, but you don't need the properties to do that. I would suggest that, I mean, I'm just speculating here, but I would suggest that the David Jones brand lends itself very well to premium-style luxury apartments, for example, that may be built on top of the stores in the central business districts around Australia. So that's an option, and we saw private equity do exactly the same thing with Myer when they bought Myer. They essentially got the Myer business for free because they sold the properties. Now, they did pay 15.5 times EV to EBIT for DJs, and I remember that private equity paid about 10 times the same multiple for Myer. So they paid arguably a bit more, so the pressure might be on to actually do that.
And generally, the department store, do you think it can be alive and well? Because there are examples in the UK with John Lewis and in the US.
Yes, and I appreciate there are isolated department stores that are doing well, but they are the exception that proves the rule, that the format is a tired format. It's a format that the younger generation don't seem to have embraced as enthusiastically as their parents and their grandparents did. Going online seems to be the thing that you do now, and you have your iPhone and your iPad and television going at the same time, doing your shopping while you're watching some entertainment.
Briefly, what about the stock market? Because here we have, it's another 5-week high, mixed picture in retail, but you know, do you think retail stocks will go on going up?
I think look, I'll stick my neck out and I'll say I think we're on the cusp of a boom in the stock market for 3 reasons. Interest rates now are negative, real rates on cash are now negative. That's forcing baby boomers into stocks. The other big reason is that baby boomers are on the cusp of retirement. They're desperate for income, so property is going up, shares are going up as a result. The determination to get a better return than the negative real rate in cash is another reason. And finally, I think perhaps the most important reason is the fact that that we've got a situation where if you don't move into shares, the fear of missing out is going to be so great, and everybody else is going to be talking about their returns, they're going to have to go into shares.
Whether it's value for money, we will see. But Roger Montgomery, that's another story. Thank you very much for joining us.